Hi, this is Scott Dahl. Thank you again for tuning in to another one of my podcasts. I'm going to do something a little different today. We're going to talk to a client of mine, David Loud, and I asked David to come in here because I thought we could discuss what makes a successful investor. Dave's been a client. Dave and Andrea have been clients for um, probably 3 or 4 years now. And Dave's a successful investor, and there's specific reasons that I've been able to identify why Dave is a successful investor, has been and is continuing to be. And that's why I wanted to bring him in because after being in the industry this long, I've been able to see people that I feel are going to do very well and people that aren't. So with that said, this is Dave, and Dave, we're going to just discuss the traits, common traits of successful investors. So he's very patient, and I don't think he's, from my experience in dealing with him as a client, he doesn't focus on the day to day minutia, and something I think that is a problem nowadays. Not a problem, but something that is people are focusing too much on what the Fed's going to do, for example, because it doesn't. I don't think it's really as important as long term corporate productivity. So with this market rally that we're experiencing, there seems like there's something else going on of a major productive nature that could be pulling this market higher. So Dave, let me ask you a question. You've your investments when you came into me were of a very long term nature, and you appeared to me to have discovered companies that maybe weren't really looked at as companies that were going to have this incredible rally and this incredible move and this incredible productive transformation. How did you identify these companies at such an early point?
It goes back a ways where I wasn't a big investor. I was just kind of studying it, looking at it, and thinking I should probably do this. Um, and some of the tips that I would get just out of the business sections of the newspaper and things like that, people just said, hey, invest in something that you feel good about. Um, just kind of do some research, but it was almost like don't fall in love with companies. Don't fall in love with a certain stock. Um, and just for example, I always just remember that it didn't matter whether for Home Depot or Lowe's, for example. They said, look, in a good market, when the housing market is great, people are fixing up their houses. When the market's slow and the housing market is slow, people still have to fix up their houses. So you look at something like a Home Depot and I, I mean, honestly, I probably, I may have some holdings in Home Depot, but I've never privately invested in that myself. Um, but that's something that just stuck with me is that you have to just know what's going to happen. Um, some of the holdings that I had been invested in the past were like Harley Davidson, and they're probably not doing all that great now, but at a certain amount of time, a whole bunch of people hit their midlife crisis and decided to all go get Harleys. Yeah, it was a good time. It was a good time to invest in Harley Davidson because once these people started hitting 40, these accountants were all going out and buying Harley Davidson. So it was another thing, just kind of watching trends that you see without having to look in a business section, but you would just look around you. When Krispy Kreme came to California, they started popping up. I'm like, well, I've done some trading in Krispy Kreme. So you have to just kind of be cognizant. And this was probably, way back in the early, late 1990s that this kind of stuff occurred. That's when that's when I really got into doing some investments. So it was different then versus now, where you have the Reddit, and GameStop or GameStop. Is
Right.
that what it's called?
Yeah.
Those kind of things. Like by the
Those
time,
manias.
yeah, you get into it now, you've already missed the boat. You've already missed the boat. The minute John Q. Public hears about it, they've already missed the boat.
Hmm.
So it was just that was what I was how I started investing, and then and whatever I grabbed onto, I just, I couldn't get reactionary. It's like, just hold it over the
Mm.
long term. Most of these stocks, as long as they're, a legitimate company, don't try to ride the wave. To me, it has to be legitimate.
Dave and I have something in common that we were both ex-collegiate athletes. Dave is a runner, and Dave still runs. How many miles do you run? Would you say a week?
When I'm really training, I'm nursing an injury because now that I'm older, I get injured. Um, Typically around 30 miles a week. So
Do you think your discipline, your athletic discipline, transferred over into your investment discipline?
you know what? I never thought of it that way. Um, and I'm just like I'm a driven person. I'm a competitive person. So you know, it probably not. I mean, it's hard to say, but probably not. I think it's just it's my overall. Probably the things that I bring to investing are things that I bring to in every aspect of my life, not only just being a good athlete. I want to be a good dad. Those kind of things that I strive to do the best. So when it came to investing, yeah, I wanted to tell everybody, I made some money.
When was the last time that you watched CNBC?
I've never watched it really.
So,
I've been to the facility when I was
uh-huh.
in one of my previous jobs. I actually had to go to the facility and work on some equipment there. But I've been to CNBC in New Jersey, but yeah, I never really watched it.
Uh-huh.
Yeah.
Because I know some people have to have it on all the time, and I've always thought that it's an entertainment program is what it is. So
Right.
people that go there from my experience and working with my clients, people that go there for their investment news, it seems to be counterproductive because I think that it creates anxiety for them, and also I think it could cause people to make the wrong decision at the wrong time. So that kind of leads me into another question about patience. How could you, as your assets grew, how were you able to have such tremendous patience to allow them to continue to grow?
One of the the reason you and I are client and I'm one of your clients is based upon one of my holdings that that I had, um, and I still have, but it was all because I was patient. And the reason and the way that I got into it, and it was Apple. The way that I got into Apple was I had when I first started doing investing, I got into an E-Trade account. Um, let's just step back in terms of just how I got into investing, because I think that might be um, a little bit more. I mean, to give the background. When I first started, I got out of college and I got a job. Um, one of the people that I worked with at that point in time said, you know what, the key to one of the keys is to always pay yourself first.
Hmm.
Okay, so he said you got to make sure you pay yourself first. So if we go way back and just to put things in dollars and cents, I had this job at this company. Um, Very low end of the company, um, probably making $6 an hour maybe. And so if you do the math, six times, what is 6 times 40? $240. So whatever. Um, Taking that money, I had put aside a certain amount of money every month. I said, okay, I'm going to pay myself first, and it was small. It was with Ameriprise.
How old were you?
23.
Uh-huh.
23. Um, so I'd put $100 a month. So here I am, I'm making $240 a week, so less than $1,000 a month, but I'm making sure I give myself $100 a month.
Mhm.
It went into this account, and I knew that it was being invested, and I knew it was being invested in mutual funds. And when I went to this advisor, he had to explain to me what a mutual fund was. But it didn't matter. I just always paid myself first. And then, after I started making more money with this company, I doubled it. I said, now I'm saving $200 a month. And it would just go. You learn to live, you learn to live without it when you never see it. If you had to be disciplined to write a check to a broker every month, probably won't, because I was 20 something years old. I can go to TGI Fridays, get some potato skins and a bunch of Coors Light. That wasn't what I was doing. It was never in my pocket, so it just kept being saved.
So you started early.
I started early. A friend of mine, he worked for John Hancock for a little while, and he came to me and said, I need to sell stuff. And I said, all right, here's another, here's $25. Just take it automatically. I won't miss it. It's helping you out, kind of thing. And I want to say that after a certain period of time, it kind of dawned on me what compounding does. Because when I finally said, I'm getting out of it, I'm going to I don't want to have you having some money, and I don't want this company having some money. I'm just going to roll everything over. And then I kind of like, wow, I've had this long enough that even at $25 a month, I got a couple grand in here now.
Mm-hmm.
And you don't realize it.
I'm always surprised at how many people, one of the first questions I ask when I'm introduced to someone new is how much are you contributing to your 401k? And people usually, most of the people I talk to, if they've gotten to me, they're familiar with saving, but a lot of them don't. Or most people will say, well, I just put in what the company will match. However, the 401k is one of the best ways to save for future retirement, because the money grows tax deferred. Sure, the companies could match, probably will match some, but the tax deferred growth is huge because you don't pay any taxes on the asset until you start taking the money out in retirement. So I always encourage everyone to max out their 401k.
Right.
And I think once you get used to, you've got a valid point there, Dave, you made, if you're not used to having the money flowing in, you're not going to do these expenditures. Another reason I think that Dave is successful, Dave and Andrea, have been successful, is because money's very important to him, like money is important to most people, but I don't think it's the most important thing in your life by far. And I think that's a huge positive trait, where it's a means to an end,
right?
But it's not the most important thing in your life, which is that anti-American, Dave?
Might be.
Might.
No, but it's easier to not focus on it when you have it.
How often do you look at your money?
Oh, I usually look at it every week. I just keep an eye on it.
So you're not looking at it 8 or 9 times a day?
No. I know how much is there, ballpark figure. I know how much is there, and it's obviously, I want it to grow. I want it to last a long time. But you can't focus on it every single day. And there were periods in my life where I would look at it every day, but it was more of a look at how good you're doing kind of a thing. It was more of a pat myself on the back thing. And just to be honest, the reason that you and I are now working together is because it became work to work with my money. At some point in time, and we were, we had a big holding in we had all our eggs in one basket. We needed to diversify, and I didn't have the time or the energy or the actual knowledge what to do. I've had, you're my fourth advisor. The first one, was when I went to Ameriprise. It was handed off to one guy. I'm sure he got out of the business or something because they just handed me off to someone else. Then I had, my third financial advisor, which was also with Ameriprise, really enlightened me to how important a financial advisor is, simply due to the fact that, anytime, you and I talk with, any of the people that we know in common, it's all like, look, Scott doesn't call me up and give me, a hot tip, like, like we're going to the racetrack. I said, it's a very holistic approach to what your money can do, how you can do what XYZ with your money. And my last advisor, she really came through with me in the clutch on something that I really didn't know about. Unfortunately, she passed away, and she was actually quite young when she did. But that was, again, Ameriprise. They handed me off to somebody, and he was doing okay. But when I had a situation on how to diversify, I got some really, I thought, it wasn't sound advice. And unfortunately, I think this person just wasn't ready for the question. And I remember that, when I called you, you didn't have an answer either. But you said, I will call you back. And you did call me back later that day. And I said, look, based upon what we've just had in this conversation, just over this, 20-minute phone call, what we talked about and what you could gather from what I was talking about, you said, that's not the move for you. What he's advised you is not the move for you. And I said, okay, then we need to sit down and really talk. And that's how you and I got together.
So the money's important, returns are important, but what's the most important in a relationship with a client is to make sure that they meet their personal goals,
Yeah.
what they actually want to do. And Dave, he wants to educate his kids to the best possible. And philanthropy is important to Dave and Andrea, and so Dave has these goals, and then what we're doing is we're working toward these goals.
Yeah. Yeah. So no, we have the goals that we have set. Really was, when my wife and I got married, and we had kids, we just said, look, she stayed home. We were in a position that she could stay home, and it said, okay, we're going to just live within our means. By the time our kids get to, high school age, doesn't matter what it's going to take, at that point in time. We didn't know what it was going to take. If it was going to have to take out loans, do whatever, borrow against my retirement to send them to private school, that's what we were going to do. So we set our long-term goals and stuck to them. And, that's the position that we're in now. But you're right. We set these goals, and it's like, you don't know. You don't know what's going to happen 16 years later.
Your motivation, your monetary motivation is not to buy the new McLaren and get.
No.
You don't see. So one of the reasons that you're successful is you're not motivated by. We all like nice stuff, but you're not motivated by possessions. You're motivated by.
No, not
So
really.
that's huge.
Yeah. Yeah, I could drive a nicer car. My wife could drive a nicer car, but it's like, hey, I just need to get. I need to get from A to B.
There's another trait that I've noticed, that a positive trait with clients is they're extremely decisive. So you're a very decisive person, and I will sincerely say that some of my best clients and my most successful clients have been very decisive. And it's kind of funny. It's like it's a two-way street. I mean, you could be the best investment advisor in the world, but if you aren't working with someone that shares a similar philosophy or that has these positive traits, it's hard to. You might not be able to do the best job, as good a job for them as what you would like to do. So, how have you always been a decisive person? Mm-hmm.
Yeah, definitely. Constantly know what I want, and that's the direction I'm going to go. And it's pretty funny. Andrea is not so much that way, but my son is. He figures out this is what I want, and he's like a pit bull. He just doesn't let go. So, but he's also a little bit flexible. So, when he's a junior now, but he's, looking at colleges, and, I get a fresh piece of paper every week of the schools that he's looking at. And, thankfully, he's moving more towards all these California schools, which, my wife and I are both happy about. But he's the same way. He's just, this is what I want to do, and he sticks to his guns. They may morph over time, which is fine. But when he's on it, he's on it.
Well, that's gonna make you proud.
Yeah,
to see those kind of traits.
Yeah, no. It's the joke in their family. He's just you. He's just a smaller version of you, Dave.
That's good. Let's go back to how did you accept the risk that you accepted? Obviously it worked, but how did you?
I want to say that I probably have a much higher risk tolerance now than I probably did in the past. When you look at a portfolio, it's a lot of, for lack of a better terms, it's paper money, or it's money on paper.
Mm-hmm.
Until you take a stock and you sell it, you don't realize any gains. So it's just paper money. So why we came to you to start working with us was to diversify. And having the meeting with you, you found out what our goals were. I made a specific income. Andrea stayed at home, and we made it clear. It's all like, look, we need dividend income in order to meet our our family needs every year. We need the dividend income. So, that's when I came to you and I said, we need to diversify and you need to get me some income with these companies, or, whichever companies, because, the dividend I was getting was not good. So, you want to get more dividends, which aren't necessarily risky companies or good solid companies. So, I do some research, with the Apple way back in the day. I used to just follow it and I would watch it, fluctuate anywhere between, 12 or probably like 18 and $20 a share. And when I got in, I had gotten in at right around $14 because I said, you know what, this thing has been tracking right around $18 to $20 for so long. And there's no reason why, you know, there wasn't some kind of scandal. There wasn't, machines catching on fire or anything like that. It was at a low. So I bought some. And then when it went even lower, I said, I'm going to buy some more. And then, we are where we're at. But, if you do some research, you can invest in stuff that isn't necessarily risky. It might have, highs and lows that are significant swings. But, I know that we just recently moved that money into a, for philanthropy. I'm in a charitable holdings, I guess that's what it was, a charity,
Yeah,
whatever it is.
it's a gifting program.
It's a
So
gifting,
he was able to gift the money and get it out. He would have avoided the huge capital gain, got an immediate deduction, and now that money's out there, so you can give it with your free will, whoever you want to give it to.
So
if it's a charity.
We have that, and I know that you and I talked about some different holdings, and I gave you the one that I had been, again, with the Apple, I had tracked it over time. This one that I said, look, put it into this because it's a great dividend and its highs and lows, while from a percentage standpoint is kind of high. It's probably, I think it's sitting right around $18 now. It's gone as high as $28. So it's at a low, but it doesn't, those fluctuations are over time, way over time. So I'm going to have this income stream, and hey, if I hold on to it for another 10 years, this stuff could almost double. So at least the principal will double. And then, the dividends that it's paying are going to make it so I can give away, charitable donations.
So that's just another aspect of that. That was your goals to help other people.
Yeah.
And so that again is a focus away from your own personal benefit from the money,
Right.
and what you can do for your other people.
Yeah.
So I think it's a personality trait. It's a lack of selfishness, and that enables you to stay in because you have a long-term goals that you've set. So one of the things there's always studies done that show that working with an investment, obviously I'm biased, but working with an investment advisor, most of the people do better because I always tell people, it's a pride. I want to do as good as I can for my clients. However, it's not my money. I don't have this emotional tie to the money. So I've in past podcasts discussed how people have a tendency to sell at the bottom and they buy at the top. They sell at the bottom because the news, it looks horrible, and they buy at the top because it looks euphorically good.
Right.
And that's why people have poor returns. And I've seen it over and over again. So let's go back to 08 and 09. That was it could have been a depression, but it wasn't. It was the Great Recession.
Right.
Who knows why? Some people give Ben Bernanke credit for that, and I probably would too. But how did you sit through that and watch? I'm assuming you watched your assets go down.
I did. I mean, we saw them go down, but they had appreciated enough that it wasn't worth selling them. Andrea and I know someone who did do the panic and sold, out of their 401k, and they just found themselves at retirement age still having to work because he reacted to the market unfavorably, and it just didn't work out for him. And it's all like, no, you just, I'm like, don't do it. It's like, well, and it's like, it's going to be at its highest. So like, it's going to recover, but you can't, you can tell people, but they don't know. And you don't know. I mean, you honestly don't know. from where I'm sitting here right now, it's 2024, and we had the Great Depression in, what was that, 29.
Mm-hmm.
So we haven't had one in 100 years.
Right.
And that's what spooked everybody. Well, we're due for one. It's like, why do you think that? You know what I mean?
There's always there's always the big scary thing
Yeah.
out there. There's always a big scary thing that's going to keep people
Yeah.
from doing the wrong thing
Yeah.
at the wrong time, or keeping people
Yeah.
on the sidelines.
Yeah.
Mhm.
But, I mean, it's not like we've had two or three. We've had one Great Depression. It's the likelihood of having another Great Depression.
Or Great Recession.
Yeah.
In our lifetime.
Well, we can have great recessions, but, Great Depression is one thing. And I think most people just immediately just thought, oh, this is the end. This is the end.
Mhm.
It's time to go jump off the buildings like they did. And it's
Right.
like, we don't have it. There's no historical basis for you to be that panicky. Yeah. Is it going to go down? Right. It is. But, after the Great Depression, the Fed stepped in and tried to do a lot of things to prevent something like that from ever happening again.
Right. I remember that sell-off in '87. I was young, but it just sold off in a vacuum. The markets did, and it was back to higher than it was prior to the sell-off in a year and a half. But so I remember these events in '08, '09, and then the COVID sell-off, and now we are at new all-time highs.
Right.
But you've obviously got to be in the correct assets. You can't be in the wrong stuff and expect to make money. So that's what's huge, is being able to pick the proper assets or the proper asset mix.
But I mean, one of the things I find too is that there's and I have friends that I say, go talk to an advisor. Just go talk to an advisor. Get your ducks in a row. Talk to somebody who can figure out what you want to do. And so they get down to the minutia. They say, okay, when you're 67, how many vacations do you want to take a year?
Right.
I said, and they try to plot it out for you, whereas most people don't even know they should have an advisor. It's like, look, if you're going to pay them, you're going to pay them a certain amount of money. And I said, but man, you need to get some kind of financial peace of mind to know where you're at. And like I said, this person that I knew that, in 2008, 2009 just panicked. It's like, if you had an advisor, if you weren't self-managing your own 401k, you wouldn't have done this, because you could have bounced it off of somebody.
Right.
But, anybody who's into, I hear this a lot too. It's all like, the stock market's just for rich people. And I say, man, if you were working for a business, if you're working for a business and you have a 401k or any kind of retirement, I said, you're in the stock market. You don't know it, but you're in the stock market.
Right.
Get with an advisor. My one friend, he's worked 4 or 5 different jobs, and he had 4 or 5 different retirement accounts with all these companies. And he's the one that I basically said, look, you need to go to an advisor. You need to get all this stuff consolidated in one place and figure out where you are. I said, because you're not managing them. I looked at some of his accounts, and I said, a lot of this is sitting in, what you're, most of them were sitting in low risk, which I said, you got these when you were young. You were advised wrong. That's when you should have been taking risks.
Yeah, you need to. You don't need to micromanage your money. You'll make mistakes. But if you need to make sure your money's allocated properly for where you're at in life. You've got a very good point about that. So you want to if you look for an advisor, look for somebody that is a referral. If you not necessarily the big money people that maybe. But people who become successful financially working with an advisor, and you interview a few, just get the feel. And I'll tell you one thing: if they come out right out of if they don't ask you a bunch of questions, try to get to know you personally, and ask you a bunch of questions about what you want to accomplish, and take a look at your assets. If they come right in pitching you something, forget it, man. That's just not the way the business is now. Yeah, you need to work with somebody that really sincerely is honest and sincerely has motivation to help you as much as they possibly can, over and above what the benefit is to that actual person. So
I've a key point there was I did deal with Ameriprise for a long time, and they were constantly trying to sell me life insurance, and as a investment vehicle, and I never did my due diligence to figure out what it is, but it didn't sound like a great one to me.
So you used your gut.
I'm like, you're trying to sell me something,
Right.
And that, that's why I like working with you. You're not selling me a specific house brand of anything. So it's like, if you're trying to sell me for example, Ameriprise life insurance, I'm like, I'm sure I can probably get a different life insurance policy through a different company at probably a better price. So if you want to sell me life insurance, sell me on life insurance. Don't sell me your life insurance
Right.
kind of
So
deal.
our goal is to educate his grandkids, right?
Yeah, yeah, I think so.
Yeah,
Oh, not
maybe
well.
maybe not. Well, let's get your kids. We'll get your
I,
kids through the chute
yeah,
first.
yeah. So let's get the kids through the
All
chute.
right.
I want to be dead before I see my grandkids
How
because my kids are still teenagers.
There's an old adage that, and I like to keep this in mind, that you don't confuse brilliance with a bull market. So and we're in a bull market right now, right? Right. I think we're in a cyclical bull market and a secular high inflation, high interest rate, secular bear market. If you go back through my previous podcast, you'll pick that up and you'll see what I think is going to happen longer term. But we're obviously in
Right.
a very strong bull market now. So how do you remain? It's against human nature sometimes for some people to remain humble. How do you maintain humility, which is so key to investment success?
I don't know. I just I think because I've just been doing it as long as I have. So if it's 2024 and I started doing it probably in, right around 2000 before that, but you've been doing it for 20 years and give you a big pat on the back. I have someone else doing it. It's what you do. It's what, you're trained in. It's your passion. And, I put a lot of trust in you to just say, hey, look, this is what time of day it is, and we need to move on XYZ. Again, I always go back to, look, you're not calling me up with, some, you got to get into this, right. And it's like, you're not a stockbroker. I mean, maybe, I don't know, I know you're a technical advisor, so I know these kind of things, but, I know that you're a technical advisor. You're not E.F. Hutton. And when you say, I listen kind of thing, those old commercials, you're not trying to get rich quick. So
I interviewed with them once. E.F. Hutton. I think Dean Witter buy them?
I have no idea.
They've been gone since
you remember those commercials.
late
like,
80s.
My broker's E.F. Hutton, and then everybody.
Those were good commercials.
Yes.
Yeah.
But again, it's. Once I started working with you, I mean, just immediately, it's just, when we had our first meeting together, we're like, okay, this guy's gonna take care of business, and it's really worked out for us. And I just have a lot of faith in my advisor. This other advisor I had, he was doing okay for me as well, but again, he got kind of, he I don't even want to say he gave me bad advice. Unfortunately, I think my question was XYZ, didn't feel like dealing with it, and I had an assistant send me out a packet. And I'm like, I don't want a packet. I want to talk to somebody who's going to tell me what I'm doing with this possible move. And you researched it and said, ain't going to happen.
How do you deal with loss? And let me tell you what I mean by that. I think one of the most freeing things from an investment standpoint, or one of the things that I needed to learn to do in order to be a successful investor and to help my clients, was to be able to take a loss. Because a lot of clients will, not a lot of clients, I think investors will sit on a position way too long, hoping that it'll come back so they can someday get even, where they could actually take that money and redeploy it and make more money. So obviously nobody can predict the future. So
Right.
Losses are part of the game, but what do?
Yeah.
You cut your losses. If you're in a bad position, cut those losses, redeploy that money in something that's going to win. So how do you get to the point where you're able to take losses and not have it affect you emotionally or affect your ego?
Because you win some, you lose some. And I mean, exactly how you explained it is exactly how I think. It's like, look, I can sit here forever on this money and hope that it just comes back. But, it's in the stock market itself, and, any kind of holdings like this, it's screwy math. If you lose 10%, it has to come back more than 10 to match.
Right.
I mean, that's just the way it is. If you lose 10% of 100, you're down to 90. In order to get back up to 100, you now have to make 11% back. So you're watching these numbers, and it became clear to me as well, like, hey, I've picked some stinkers, typically usually pharmaceuticals, because you never know when the FDA is just going to just red light someone's big thing that's going to pop, and then you're left holding the bag. Basically, you're like, well, that went down. Why sit there? They don't have a secondary drug in the pipeline. They might, but you're like, I'm going to just let it sit there and hope it comes back.
So you never invest, depending on how you invest money, if you do invest in individual companies, never go into a trade without knowing what your risk is.
Yeah.
In other words, if you'd be willing to lose that amount of money and accept the fact that you were wrong on that particular trend and move on to the next one.
Yeah.
So I usually say, well, I don't know, Dave, 2 to 1 is okay, 3 to 1, 4 to 1. So losing 1 to make 4. So if you determine the potential, then you determine the risk. That is if you're doing individual stock issues.
Right. I never even really monetized it, a lot of, or, put it into percentage, how much it just needed to come back. I just would go into any kind of stocks or any kind of trades and figured, hey, if it can make me this much money, but if it could lose, and I don't know necessarily how much it's going to lose. Going back, from history of where my mindset is with actually, not just money, but everything in general. So like, look, they say, I'm going to Vegas. Okay. One of the worst things that people do is say, well, I'm willing to lose this much. I'm willing to lose this much. It's like, see, you've already lost. You've already lost.
That's a good point. You've
say,
predestined the fact that you're going to be a loser.
You're going to be okay if you lose as much. I said,
right.
Tell me how much you're planning on risking.
Yeah.
Semantics now.
People always said they were paying for their fun, but I never saw losing money as fun.
No.
I like making it, but I sure don't like losing it. But I could never figure that one out.
Yeah. No.
Yeah.
But
especially back in the old days when there was cigarette smoke blasting in the face.
Yeah. But
Yeah.
I thought that
Then you get a free drink of rock gut whiskey.
Oh yeah. Yeah, the free drink.
It costs you $300.
Exactly. But some of these things that I just picked up, over time, again, when you go to Vegas, you don't say, how much am I going to lose? You say, how much am I willing to lose? How much am I willing to risk? They may be the same. They could honestly be the same, and it could give you that stop, how much you're going to do it. But it's from me, money and finances is a mindset. It's your mindset.
It's a mindset.
So, I still hear people, oh, it's all right. I'm willing to lose $500 if I go to Vegas. I'm like, hey, you might as well just leave it here with me.
You ever read the book Zurich Axioms?
No.
I don't know. Anytime I'm listening to somebody who I feel is very, very, very qualified to be dispensing advice, which are very few, but I listen to other people that I think are good. If they give me a book recommendation, I'll read it. And that Zurich Axioms, that's one of the best books I've read about investing. And that's what it's about, is mindset. It's an old book.
Yeah.
So let me ask you a relatively personal question, Dave. You retired for about 3 months and then went back
for the
to work.
summer.
And then what made you go back to work?
The bigger thing was, why I left the workforce. It was a set of circumstances at the place that I was at. They wanted to cut hours and or reduce my pay, and I'm like, it's just not worth making this commute in post-COVID traffic. I was driving in and out of Hollywood, and it was just a bear.
Why'd you go back? Not to them, but why'd you go back?
Because I could work from home.
Great.
So I could work from home, and honestly, every single one of my cohorts in life are all still working too. So with kids in school and everybody that I know except for my wife working, and with kids in school, I think I told you this before. So it's not like the wife can just, hey, let's just go XYZ and have fun. Let's go to Napa and do some wine tasting.
Might as well make
like,
some more money.
Yeah, well, who's going to pick up the kids at 3 o'clock?
And you like what you do. It's interesting for you.
It's fair.
And does Andrea still bring you a sandwich every day?
Yes, she does.
For lunch?
Breakfast and
lunch at the work desk?
Yes.
Yeah, we're going to have to discuss that with my wife and see how we can work that out.
Oh, we're on Zoom meetings, and the people on my Zoom meetings see her drop breakfast off, and they're like, what the heck?
That's a good deal. So I'm just taking some notes here. So successful traits: the patience, the decisiveness, discipline. Understanding and accepting volatility, setting goals, persistence, confidence, humility. Anything else you could toss in there? Being
Good,
patient,
yes, good looks.
good looks. Good looks doesn't hurt.
No, no. You have to. I think you really have to. Again, when I go back to some of my friends, I talked to somebody yesterday. It was just funny. I was talking to somebody yesterday about he has a special needs son, and him and his wife paid off their house, and they're all like going, hey, you know what? The wife keeps saying, hey, the house is paid off. If something happens to us, we're set. And I said, and he and I were just talking about how some people just don't understand
That's a good point,
that
Dave.
that's just not necessarily it. And I said, for your son, I said, it's great that he has that. And I said, but he needs to then turn that into a rental so that he has guaranteed income.
Right.
I said, because if he can't ever get a job, he'll never pay the taxes. He won't be able to maintain the property, and they'll end up selling the house.
Right.
He'll get a big giant chunk of money, and he'll piss through it. And it's like, the wife's mentality is the house is paid off. He'll always have a place to live. And it's like, no, because he misses one tax payment and he's
Right.
out.
Well, what I find interesting, and I see this time and time again, where I'll meet someone or someone new prospect will come in and they'll say, "Well, I want to pay my house off," and I'll say, "What's your mortgage?" Well, we're 2 3/4 on a 30-year, and you can take cash. I'm not suggesting this. You can take cash and make 5.3% now. So
Right.
why would you take that money and pay off your house, which is also a good deduction? So I just
again, I mean, and I'm giving you a plug, but I mean, people have to get an advisor because they need to be able to bounce these ideas.
Mm-hmm.
And I mean, I thought of it when I went back and I talked to you, we've talked about this too, but when I had my other advisor, the one that passed away, I was going to do something along those lines. I was going to make a fairly boneheaded move, and she explained why I didn't want to do that.
Uh-huh.
This is why you don't want to do this. And it's understanding the nuts and bolts about money. And if you don't know it, that's fine. Some people don't want to learn it, but get somebody to manage your money, or at least get somebody who can keep you from doing stupid stuff.
Right. Charles Schwab made a fortune by convincing people back in the 80s that you could invest yourself. And so I think that set the whole precedent for the do-it-yourself investor. And it's exciting too, if you think about it. I mean,
it
you
is.
want to play the game. If you want to make money, grow wealth, that's one thing. But if you want to play the game, you can trade it all out.
You have our holdings. You're in charge of that, and I have a couple of, I have three different accounts. I have my own trading account, and it's small potatoes, and it's with the kids as well, and that's where I get to go and kick myself in the ass. I should have had Scott put more money in there, but it's a win or lose game. So I still get that thrill.
Right, that's a good point, Dave.
You still get that, but I know that my money is actually it's in a good spot. I'm not going to be able to do something really asinine with it.
Right. So we'll grow it. Grow it for a long period of time and just make it as big as reasonably possible within your risk tolerance. That's what we're going to do. So I want to thank everybody for tuning in. This has been a lot of fun. It's been a pleasure to talk with Dave in front of the camera to get his philosophy and ideas on what makes a successful investor. I'd also like to thank Dave and Andrea for being clients. I'd like to thank all my clients. And if you have any questions, you can reach me at dahlcapitaladvisors.com. That's phone 949-497-6366. And it's Scott at dahlcapitaladvisors.com. So thanks for tuning in. Look forward to future of these, and call me if you have any questions. Thank you.